Hey, what's up everyone? Welcome back to the channel and I hope you're all doing well. Interend, ticker symbol IIP.UN. This is a growth-focused REIT specializing in multi-residential properties. And as you know, Canadians love their residential real estate. Just look at the current state of our housing market. So why should Interend be part of your portfolio? 1. It has a growing monthly distribution. 2. It's seen capital appreciation in its stock price. And 3. You get exposure to a portfolio of multi-residential properties across the country. Their main business model involves investing in assets that are undervalued or in dire need of investments. They then go out, acquire those properties, renovate them from top to bottom to unlock a higher asset value. And when you do that, you also get to increase your cash flow because all of a sudden those properties are a lot more attractive now. You then rinse and repeat that strategy by continuously acquiring undervalued assets. It's a simple business model, but it's a model that works. The other piece, they focus on sustainable growth, which is important to investors like you because you don't want your monthly distribution getting cut, especially when you've become to rely on that income source. And when I mean growing distributions, I really mean growing distributions. Take a look at this chart. They've been growing their distributions at an average rate of 11.7% over the last 9 years. The smallest increase was 5%. The largest increase was 33%. Not only have they increased their distributions, but the stock price has significantly gone up. It went from $1.50 in 2009 all the way to over $15 today. So if you do the math, that's over an 1,100% return. This is one of the most underrated REITs on the TSX. In that very same time span, they've also increased their number of rentable suites from 4,033 to 11,977. And that's exactly what you want. You want businesses to increase their asset base. Why? Because that means you get a larger distribution. The more money REITs make, the more money gets passed down to you. That simple. Another fun fact, this REIT does not get a lot of media coverage and it's very underrated. That's why you want to hit that like and subscribe button on this channel so you can learn more about these undervalued stock picks. Taking a closer look at their nationwide properties, they have a portfolio of assets all the way from Vancouver to Montreal. 17 properties in Vancouver, 20 properties in the nation's capital in Ottawa, 30 properties in the GTA, and 22 properties in Montreal, representing 113 properties. Not only is Interend known for growing their asset base, but they're also known for caring about that resident experience. Because at the end of the day, they're in the business of residential real estate. And how does that business work? Well, you need people to rent these properties. So ultimately, you want to care about your residents because the more you care about them, the more they'll value your assets. And they've been doing that by investing in critical infrastructure. So residents are able to access a whole array of online services, all the way from applications to payments, maintenance requests, amenity bookings. And they've done that by investing in business intelligence software, best-in-class cloud platforms, automated AP workflow, fully connected properties, and a mobile-enabled workforce. All that to make the experience that much better for everyone involved. They also have a proven track record of acquisitions by investing in $1.5 billion worth of properties in the last few years. Just in 2017 alone, they acquired 602 suites. In 2018, an additional 638 suites. 2019, 1,214 suites. 2020, 880 suites. And in 2021 so far, they've already acquired 930 additional suites in St. Catharines, Ontario, and Vancouver, BC. As I mentioned earlier in the video, that they're known for unlocking value. Well, how do they actually do that? Well, here, take a look at some of these before and after pictures. You'll see that they go in and they go ahead and do exterior upgrades to make sure they're a complete, attractive first impression package. Designer influenced exterior finishes. They also focus on common area upgrades by adding additional functionality. Designer finishes enhance security. And it's not just for looks on the outside, but they also care about the inside by adding unit upgrades, by improving the suite layout, upgrading bathrooms and kitchens, and upgrading the flooring plan. And for residents, that makes all the difference by having an amazing place to call home. Honestly, after looking at these pictures, I'd rent one of their properties. Look at their financials from 2020. They had revenues over $160 million. Operating expenses came in at $58 million. That gives you an NOI, or net operating income, of $102 million, which translates into a net operating margin of 64%. So these are the metrics I've been talking about. You want to see healthy operating metrics. More cash flow for the business means more cash flow for you. Again, that simple. And as I mentioned, one of the great things about Interend, it's a growth-oriented business. They've been consistently growing their revenues in the last few years. Their revenues have gone up. Their NOI has gone up. Their FFO has gone up. In the last years, they've heavily been investing and increasing their operating revenues. Not only that, but they've also increased their NOI and FFO. These are all indicators you want to see that are growing. Looking at some FFO math for Interend, if you invest $1,000 into Interend today, that'll net you 65 shares, giving you a monthly distribution of $1.76 or $21 annualized. And if you invest $10,000, that'll get you 651 shares, a monthly dividend of $17.65. Annualized, that's $211.86. Keep in mind, this is just today's distribution, but you also get capital appreciation along the way. And for the exact same shares that you hold, you'll also see a larger distribution as they grow their business. The best part about investing in growth assets like this is that you get paid more and more year after year for owning the exact same number of shares. So you don't have to do anything on your end, you just get paid more for doing absolutely nothing. Like in the current share price, they're trading at $15.35, giving you an 18% discount compared to pre-COVID levels, meaning it's still undervalued. If financials are stable, and if that growth momentum continues, Interend will be a long-term profitable bet for sure. Welcome, Granite REIT, ticker symbol GRT.UN. They specialize in acquiring, developing, and managing logistics, warehouses, and industrial properties across North America and Europe. By investing in Granite, you get exposure to over 100 properties across 7 countries, representing 50 million square feet. Granite also has one of the best occupancy rates across REITs at 99.6%. Their roster of tenants include well-known names like Magna, Mercedes-Benz, DHL, Wayfair, and Walmart. Granite focuses on owning and developing institutional quality real estate, meaning they focus on maximizing the total return for shareholders like you, being able to generate a stable cash flow and to grow that cash flow. Granite is a long-term total return focused approach. This long-term total return approach means you get capital appreciation and a growing stream of monthly dividends. They have a market cap of $4.5 billion and an enterprise value of $5.9 billion, meaning this is another undervalued, underappreciated gem of a REIT. They have a net leverage ratio of 25% and 9 consecutive annual distribution increases. Looking at their financial performance over the years, they have grown their revenue every year. In 2013, they had annual revenues of $203 million, and they have grown all the way to $340 million in 2020. Not only have they grown their revenues, they've also grown their EBITDA and FFO at the same time. They've also maintained a very healthy payout ratio in the 70s, and the distributions have gone up every year. They've also managed to grow that distribution, which was $2.11 in 2013, and has grown to $3 in 2021. And in terms of total performance, they have consistently outperformed the TSX. Since 2012, they have generated almost a 300% return for their shareholders. Compare that to a 95% return on the TSX. They have a globally diversified portfolio, all the way from the United States with 47 properties, Canada 30 properties, Netherlands, Germany, Poland, 12, 11, and 2 properties. And when I talk about their growth-oriented business, I mean it. Take a look at their recent acquisition, which happened in March of 2021. They acquired an additional 1 million square feet in an income-producing property in the US for $85.9 million. And as I've been saying all along, the more money REITs make, the more money you make as a shareholder. So you want them to go out and acquire more properties. You want them to grow that distribution so your income can grow. So that way you can get ahead. There are so many reasons why investors love Granite. It's profitable. It has a globally diversified property portfolio. It has a strong balance sheet, and to boot, its revenue is continuously growing. So if you only have $20,000 to invest, and you invest in Granite, and it maintains a growth rate of 15%, that means in about 30 years, that $20 million investment can turn into $1 million. Not bad for taking a $20,000 investment. That's a full retirement portfolio off one investment. Industrial real estate stocks offer investors a ton of growth potential, especially when you consider the growth in e-commerce. We're doing more and more online shopping, buying groceries online. All that needs to be stored somewhere. And the other piece, if you have Granite as part of your portfolio, that's also a hedge against retail real estate stocks. Looking at some FFO math, if you invest $1,000 into Granite, that gets you 12 shares or a monthly dividend of $3. Annualized, that's $36. If you invest $10,000, that gets you 127 shares in Granite, a monthly distribution of $31.75, or annualized, that's $381. Again, may not seem like much, but keep in mind, you want to focus on capital appreciation and a growing stream of dividends. So if you invest in some shares today, those very same shares will be worth more tomorrow. And not only that, but those very same shares will be paying you more and more in monthly distributions. So what does it take to get into Granite? Well, it's currently trading at $78.69. In fact, this has been one of the best performing REITs. It has grown past its pre-COVID levels, while other REITs are still trying to get back to pre-COVID levels. Even though Granite right now is trading near an all-time high, I still think there's a ton of growth potential. It's an amazing business, and a business that's only likely to see even more demand. As e-commerce continuously grows, the demand for warehousing will also grow, because all those goods need to be stored somewhere. As the world moves more towards e-commerce, and you buy more things online, from groceries to everyday shopping, all those items need to be stored somewhere so you can get same-day delivery or the next-day delivery. And that's where REITs like Granite come in. Thank you so much for watching. This channel would not exist without your love and support. So please do me a favor, check out the links in the description of this video. I have offers of various discounts and sign-up bonuses. Every click directly supports the channel. If you have questions for me, feedback on this video, or maybe you have ideas on future content, please let me know your thoughts in the comments below. And while you're at it, please make sure you hit that like and subscribe button. It makes a huge, huge difference. That's it for now. I'll catch you guys in the next one.